Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video, we will be looking at when to sell a stock. Okay, recently some of you asked me if I can do a video. We always talk about, a video about when to sell a stock. We always talk about basically buying stocks and holding it for the long run, for the long term. So what do we do in situations where that basically something has happened to the company or whatever it is? When do we sell it? How do you know when to sell it? And that's really important. So it's also important to know why you're buying a company, when to buy it, basically looking at the valuation of the company, fundamentals and all of that stuff. But it's also important to know when to sell it. And that's what we're going to look at today. Last video I've talked about, basically what's going on in the market right now, the bear markets and so on. And I did say I want to share with you my dividends, the dividends that I'm receiving this month, but I forgot to add that to that video. So I'm just going to, if you haven't seen that video, go and watch it first, But the dividends I want to talk to you about is this, So right now my predicted in dollars, is $1,524 a year. That's my prediction, So that's what I'm predicted to get. Again, it could be less, it could be more. And again, I have to pay 15% on top of that. So just don't forget that because I'm UK based. So obviously I have to pay taxes for US stocks. Some of them obviously are not US stocks. But as you can see in July, I'm expecting $271 basically for this month. Next one, 32, the next one, 50, almost $60, and then 300 and so on. The reason I want to I was talking about basically dollar cost averaging and buying dividend companies. So when I get this money, what happens? I reinvest it into the portfolio. And that's really important. As you can see, every single company that I own in here, in my portfolio is actually more or less blue chip companies that actually have a reliable dividends, The only one that has a crazy situation going on with is Rio. Rio's payout ratios is quite high and obviously are not as reliable as the others according to Simply Safe Dividends, But because they're UK-based company, I do like it and I only own, I think, about 8 or 10 shares or whatever it is. So anyway, so that's what I wanted to share with you. Again, this is the power of dividends, Every single month I get paid. Every single month I reinvest. I put more money on from my job, and then I basically reinvest any dividends that I get, and that kind of helps me to compound and then start the compounding effect and all of that stuff. Right, so let's have a look at some of these strategies, that you could use when it comes to selling stocks and so on. Right, so the first one is you basically bought a company, and when you bought this company, there was thesis, there were situations that was going on. You actually liked the company because of whatever, right? What if that changed? What happens if the reasons you bought a stock might no longer apply? So what you then need to do is you need to examine why you bought it in the first place, and see if those reasons are still valid. And if they are not, something has changed, then you might consider selling it. And the reason I say that is because if your thesis have changed and you don't no longer think this company is, fulfilling the reasons why you bought it in the first place, then what might happen is if the stock goes down or something happens, you're gonna panic sell anyway. So you might actually think about, have a strategy, look at it, companies that you own and say, okay, do the reasons I bought for this stock in the first place, are they still valid? And if the answer is no, then obviously you're going to have to sell it. So the company's market share, for example, start falling. So what happens? Then you might say, okay, why is this company going down? And then you realize, okay, because a competitor is offering a better product and people are moving away from this company to a new company. So that to you, maybe you thought they have a wide moat, and then all of a sudden the new competitor has actually taken over, and therefore the company is not gonna make as much profit as you predicted from day one. So that is one of the major reasons to sell a stock. It could also be the fact that the company's management has changed and all of that stuff. You realize the sales have basically slowed down. there are loads of different reasons why you based on the thesis might change. So if the revenue is declining, if there's a new competitor offering better products, if the management have changed, if the company has more debt or whatever, in those situations, okay, you might decide to sell it because it's no longer, okay, it's no longer basically the reasons have changed for you that you bought it in the first place, because you were expecting sales growth of say 20-30% every single year of the next 10 years, and right now you realize it is minus whatever. Right now I'm in that situation, not sales side of it, okay, the revenue side of it with Pfizer, because of COVID, their revenue will definitely start declining, and when that happens, okay, their stock might go down, and that for that reason I'm thinking of taking my profits now, and if it hits the target prices that I want later on, I can buy back that. Okay, I've actually trimmed it recently, and I shared it in my last portfolio update, but that's one of the reasons you might want to sell. So the next one is the company is being acquired, and this is probably the easiest one. Okay, so for example, Activision Blizzard is actually being bought by Microsoft. In that situation, what happens? Okay, so you might get cash from the company, you might get shares, whatever of the other company, whatever it is. Okay, this is out of your control. Okay, so another company is acquiring this company. So all cash, basically, if they're buying it all cash, then you get cash. Otherwise, you might get stock of the other company. And in that situation, it's very simple. Okay, you just have to do what you want to do, but obviously you have no control of that. So Activision Blizzard did this, basically is now in the process. Slack was another one, Slack Technologies. Okay, Salesforce bought them. Okay, and I think it was an agreement that they will do like a cash and stock deal. Okay, so in those situations you really have no control of, and you might sell your stock. And in fact, that's what I did with Activision. I had Activision as soon as the news was announced. I was down, I think, about £200 or something. As soon as the news was announced, it went up and above where I bought it for, and then I made, I think it was £100, £200, whatever it is, profit. I took that profit. It's actually never gone back to that stage. I know they've said, I think it was $95 per share. I don't think it went back up to that situation ever again. So I've sold it. I think it was about $90 per share, $80. I can't remember exactly, but I made a little bit of money, and that's probably one of the easy ones. Okay. And one of the easy situations where you might have to sell a stock. Okay. The next one is you need the money, or soon you will, basically. Okay. Now, I've always said, do not put money that you need in the stock market. Do not invest in money that you might need in the next 12 months or whatever, or 2 years, 3 years. Okay. And the reason I say that is, right now, if I imagine I needed my money, right? I've initially had about £50,000 in there. Right now it's like 48 something, right? Imagine if I needed to buy something, right? And right now is the time that I need. If I sell everything right now, I'm actually going to lose £500. That's not good, is it? So you need to put money into the market that you know you're not going to need anytime soon. That's my advice to anybody, okay? But if you ever need the money, okay, you're in a situation where you need the money, obviously you will sell it. Obviously, if you haven't got any other revenue or anything else coming through, then you will sell it in that situation. Okay, so that's the next one. The next one is you need to rebalance your portfolio. What I mean by that is, for example, okay, you've owned high flying stocks, whatever, for the last few months, basically years, and right now those companies are declining, and which they are. You might decide, okay, I'm gonna basically sell half of my portfolio and buy more dividend stocks. Okay, so you're focusing on more on the long run, companies that can sustain their basic revenue and all that stuff during recession times. And the other one is if you own, for example, a high performing stock, okay, and the shares of that company have significantly increased in price in the last few months or years. So your allocation was supposed to be 5%. So you made a decision, every single company in my portfolio will only be 5, because that is quite a lot of actually investors and famous investors actually say don't do more than that. 5% is perfect, right? So what happens if a company, because of the price increase, whatever, becomes all of a sudden 10%? And in that situation, you sell 5% of that company and you keep the other half. and bring it back to where it is. So that's what I mean by rebalance your portfolio. Okay, so it could be the fact that you've now all of a sudden basically made enough money on Tesla, and that actually did happen to me at one point, and I keep trimming. Tesla was in my portfolio. It was basically going up every single week, and I keep selling it, and I took a lot of profit. I think I made over £4,000 or £5,000 in just a space of a few weeks, because it kept going up. And they had a split, and they had this news and that news, and I had at the time 12 or 13 shares or whatever it was. So yeah, so sometimes you might need to rebalance your portfolio. The other thing is, if you are in a situation whereby you're almost getting closer to retirement, and you had exposure to certain companies like the tech companies, whatever, you might want to rebalance your portfolio to basically have more stable income companies, high yield dividends or whatever. And in that situation, what you'll do is you'll sell the companies that are high flyers and pay low dividends, and buy companies that will, because you remember when you're in retirement, you need the income, right? So you'll buy high dividend yield companies maybe, and maybe have a balanced portfolio instead of just basically having all high flying companies in your portfolio. So that is the next one. Okay, the one after that is, and the final one is, you identify opportunities to better invest your money elsewhere. And actually, to be honest, this is really important. And a lot of people think, sometimes I sell the stock because I see opportunity, better opportunity somewhere else, and you should do. Okay, if you go to the shops, for example, and you're buying brand new trainers, right? And you see a cheap one on the other side, just it looks exactly the same. Okay, well, but maybe better quality, then what would you do? You'll buy that one. So it's the same situation here. You see a better investment, you take this money out and you put it into the new investment, because you're going to make more money in the other company. Okay, and a lot of times what happens to me and what happens to other investors is, for example, you see a company that you really like, you've been waiting for a long time to come back to your fair values. Okay, and all of a sudden, what happens is the stock market goes down, the company is now exactly where you wanted it to be, okay, and you want to buy that company, but you don't have the cash right there and then. Then you look at your portfolio and say to yourself, okay, are they similar? Is there another company in that sector, in that whatever, that is right now in my portfolio that's not doing as well, okay, that I can sell in order to buy this new company? Okay, and that's sometimes what you need to do. Again, you are a portfolio manager. Don't forget that. You're managing your own portfolio. You're looking at better opportunities. You're looking for companies that will give you whatever you're looking for. So if a company, for example, in healthcare, I have Medtronics, for example. Right now, I believe Medtronics is actually a better investment in the long run, okay, than Pfizer. So I might take my money basically from Pfizer, just take my cash, because that I'm actually up for it in just a little bit. So I might take that investment and put it into Medtronics, and obviously I'm going to make a little bit of profit and buy a company that I believe is undervalued at the moment, and hopefully in the next 5 to 10 years it will give me better returns. And that is something that you need to think about. So that is all I wanted to share with you guys. Okay, so that's the 5 strategies that you could potentially use, and I use that all the time. So whenever I actually sell a stock, if you watch my portfolio updates, every time I sell a stock, I've talked about why I sold that stock. Okay, and the final thing I want to talk about generally, okay, is what I want to say is basically from Sharia compliance side of things, because I sold recently Stanley Black & Decker, and the reason I sold that stock was because it became non-compliant. What I mean by that is, according to Zoya and according to the scholars, okay, in the, what is it called, the I can't remember, AAI, OFA, whatever they call them, okay, they come up with these basically criteria, and the criteria is the debt levels shouldn't be above 30 or 33%, depending on who you talk to, right? So it went above that, but a lot of it was because they got more debt. They got into more debt because of the market cap was actually going down, obviously, because the stock was going down quite a lot. And on top of that, they were actually getting more debt from the banks. So that is one of the reasons I've sold that stock. So let me explain again. So what happens is, if you own a stock and it goes, the debt levels goes above 33%. Let's just use that as a example, okay? 33%, which is basically one of the ways that you can look at it, either 30% or 33%. So if it goes about 33%, are you going to sell it straight away, or are you going to wait? My rule of thumb, again, is this is not based on the scholars or nothing like that, okay? I look at the company, why it became non-compliant straight away. If it's something to do with the revenue, I will sell it straight away. Meaning, for example, Coca-Cola I had in my portfolio, and I had PepsiCo in my portfolio a long time ago. Both of them came up and said, we are now getting into basically alcohol side of things. So they start teaming up with companies that make alcohol or purchasing these companies. And in the next 5 to 10 years, you will see their revenue will include, okay, basically some of that their money will come from alcohol, the sale of alcohol, because that's actually something they want to work, basically diversify into. For that reason, I've sold them straight away. There was no question whether I was up or down. I've sold it and I basically left. And luckily at the time, both of them I was up, so I sold it. I took my profit, right? The next thing is, if the company is non-compliant because of the financial ratios, like for example, the debt levels is too much, because the market cap went down so much, okay, then I will wait for that company. I will wait 1 quarter, 2 quarters, and see how the basic things go. If the company became non-compliant because they actually issued more debt, they taken more debt, whatever, then I will also sell it. Because I don't want companies that have so much debt, because it's not even a good investment anyway. Not forget about Sharia compliance, and it's generally not as good investment, okay? So I will sell in that situation. But if the company is down, so for example, VFC Corporations is actually down right now, is non-compliant. It is 30, it's actually 30.99. So according to Zoya, is non-compliant. Why? Because they're not issuing more debt, because the stock has been going down and down. And I think I'm down like 400%. Not 400%, 400 pounds or whatever, right? So because of the market cap goes down, the debt levels obviously stayed the same. And when you do your maths, basically it will be above 30% or 33%. For that reason, I'm not worried. I'm going to keep that company. It's still in my portfolio, okay? And I'm going to keep it for the next quarter and see what happens. If I found out the company is issuing more debt, then I'll get out of it. And that's exactly what happened with Stanley Black & Decker. They were issuing more debt. They have no free cash flow anymore, and their market cap was going down. There was a lot of red flags, so I took a hit, and I told you about it about a while back. So that is the other side, the another situation where I might sell stock. Okay, I hope that makes sense. I hope you enjoyed the video. I wanted to make this video about 3-4, basically 5 minutes or whatever it was, but now we're looking about 17-18 minutes. And the reason I just like to explain it thoroughly, some of the things that I'm talking about and what's in my head. Okay, I hope you enjoyed the video. If you have and you are still here watching, please like, subscribe to the channel. Let me know if you have any questions. Have a wonderful day. Assalamu Alaikum.